Hi, I'm Mike Ward. I want to talk to you about financial signaling. How do companies signal information to their investors? So we make some assumptions. We assume, and we know, in fact, that managers know more than outsiders, than investors, because they're insiders. They can see what's happening. They have a better sense of what are the issues in their industry and what their competitors are doing, and they know whether there are products which are going to do well or have got problems and so on. So investors also know this. They know that insiders, managers, know more than they do, and they also are aware that insiders do not always want to disclose everything. Sometimes they're hoping bad news will go away. More often, if they tell investors too much, competitors get information that they don't want them to have. So they would prefer many times not to give away too much, especially about R&D and special things, because that might attract more competition. So we also know that investors react to public information in ways which make sense as they read it. So let's just dive in a little bit here and talk a little bit about investors. There are different types of investors, some who rely a lot on financial statement information. Some sell-side analysts are looking for bad reasons, bad problems that they see there. They'll look at an Altman F score or something and try to predict corporate failure, or that there's some hype, overhype in all of this. And of course, active investors are busy making decisions. Value investors are looking for opportunities, and they're going to look carefully at your financial statements to make those decisions. On the other hand, we can see that index funds, who are sophisticated investors, certainly understand stuff, are not really interested in financial statements. And you might say the same of retail investors. They don't really, they're not that sophisticated. They don't really rely on financial statements and so on. Chartists, also technical analysts, are not that interested in financial statements. And I've put people there who invest in smart beta. You could also call those concept investors, depending on who they are looking for other things. They're just buying shares because they are small, or because they are value versus growth, or those kinds of things. So we need to take into account that there are different kinds of investors. Now, in terms of disclosure and policies, dividends communicate a lot of information to investors. The dividend is essentially proof of the earnings. When you pay out actual cash, investors take note. And what they're looking for here is not so much the amount that you're paying out, although that can be important. Some of them don't want any dividends. There are clienteles of investors who are not interested in dividends. To them, they don't want the cash. They don't need the cash. It's just going to incur more costs for them to, that if they don't need cash, if their cash flow is positive, they're going to have to go and reinvest the money somewhere anyway, typically buying back your own shares. So, but all investors are interested in is a consistent policy. It's when you change the policy. Now, by policy, what we mean is, are you paying out a certain percentage of your earnings? Every year, do you pay out 50% of your earnings or 25% of your earnings? Whatever the policy is, they're looking for changes in the policy. That's what interests them. And as we mentioned, the actual dividend underscores the quality of the earnings. So they want to see the money. Show me the money. Stock repurchases, share buybacks also focus investors' attention on companies and normally are a positive signal, as you'll see. And it's possible for companies to also target particular types of investors, private capital, and so on, with different strategies. Now, let's focus on dividends, which are an important measure of signaling to investors. This is a study by a guy called Pettit in 1972. I remember seeing it when I did my MBA many years ago in the Journal of Finance. And so this is what we call an event study. And what he has done here is he has gone back 20 months. These are often in days. And he has gone forward looks like about a year. And he has grouped companies into different categories. Some companies which dropped their dividend, omitted, others which reduced their dividends, others which had never paid a dividend. This is their very first one. There were only 21 firms there. 8,959 shares didn't, companies in his analysis didn't change their dividend policy. So if they were paying out 25%, they kept on paying out 25%. So this is based on announcements. If they made an announcement as to what they were going to do. Companies which weren't changing their policy, you can see didn't actually make announcements. So picking this up after they paid the dividend as expected and so on. So it's a little tricky reading these kind of graphs. And these days we prefer to zero things around the event day, the announcement date here. But what we are seeing here is prior to the announcement, some of these share prices are going up. And typically the shares that are going up are the ones which increase their dividends. So for example, let's look at this here. This group of 89 companies here increased their dividend by more than 25%. So if they were paying 25%, they increased it up to, or by more than 25% of what it was. And you can see that they're increasing their dividend because their share price is going up. They're obviously successful in whatever way, but after the announcement, actually, it doesn't really move the margin. In fact, it drops slightly post the announcement. And in fact, in almost every instance, what you see here is having got the money, what happens is the investors say, thanks very much, you have ticked the box. The only ones that really go up after the announcement are initial payments. So the very first time you pay a dividend, and typically these companies have been doing very nicely, and they then announce their first dividend and the market says, lovely, thank you so much. That was a surprise. We got it and we're grateful for it. Thereafter, you can see it's pretty much downwards for every company that is announcing its dividend, even if it's a no change. What we do see, though, is that companies that cut their dividend here, they, first of all, evidence that this was going to happen seems to be in the market prior to the announcement. And after the announcement, you can see, again, it just drops pretty much by what was expected. And similarly, these are companies doing badly over here, which reduced their dividend, and the company does not like it. So but it's already in the market in the sense that they have been reading what's been happening and are anticipating this. So we see quite a good sense here of market efficiency. And I guess the main message is that the first time you pay a dividend, share price is going to love it. Otherwise, you should try not to cut your dividend. The market is going to hate you already, but they certainly aren't going to like it when you reduce or cut your dividend. Most of the rest of the time, they just anticipated it and they are going to assume you're going to keep on doing this, and they're glad they've got the money. Now that they've got it, you're going to see a slight drop over the next few months. So on the other hand, if we do this slightly differently here, this is looking at what we call style analysis. So it's like a buy and hold trading rule. And what we're doing here, and this is looking at South African data back to 1986 here, and we have divided the shares based on their dividend yield. So that is the dividend divided by the share price. And these are very high dividend yields in the red portfolio. These are quintiles. So we've taken the top 160 companies listed on the Johannesburg Stock Exchange and put them into equal weighted portfolios based on their ranking of their dividend yield. And these are readjusted every quarter as the information becomes available. So if you consistently buy shares which have got the highest dividend yield over the long term, you can see you do pretty well. In fact, you will observe that the color code here is in direct alignment with the colors we're seeing down here. Companies which have got a very low, the lowest dividend yield are the ones which did the worst. And the ones which did the best are the ones which paid the highest dividend yield. So what's it telling us? is in general, companies that pay high dividends are going to outperform. So that is worth knowing. Shareholders like to get dividends in general. If we look at some other kinds of signals that companies can send, occasionally companies announce a share repurchase, a buyback, and we've seen a lot of those prior to COVID, mostly because companies are sitting on lots of cash, didn't know what to do with it, and did not want to reinvest it, which was a problem. And now we've divided this, again, this is looking at South African data, but you'll find similar results elsewhere. Open market repurchases is just a general purchase. Company announces it's going to start buying back its shares over the next few years, up to some level. Sometimes they're a bit more specific. These are specific repurchases for particular reasons. And we've also included in this graph special dividends. So a special dividend is an unexpected dividend where a company announces, because it's our 25th anniversary, or because we've done particularly well, or because we've got this new contract, we are going to pay a special dividend. Don't anticipate this every year. It's a once-off. And so we've got these three categories. And the first thing we can observe here is, let's look at the special dividends. You can see they weren't expecting much prior to the event. And then the announcement comes through, and you can see there's a bit of a splash. Price goes up by about 5% on average. Well, not price, these are abnormal returns, what we weren't expecting. But then it drops a few days later and over the next couple of months. And then, it's good news, but not that exciting. Special repurchases, again, generally speaking, markets seem to anticipate that something's going to happen, and it's good news. Within about the first couple of years, these are trading days that we're seeing down here, the abnormal returns are up about 15%. So they like to hear about repurchases in general. If it's an open market repurchase, without any real criteria, the company announces it's going to be buying back its shares for some time, you can see that this is quite positive. It sort of settles at about a 40% abnormal return over about 3 years. And so I guess what we read into this is that when a company announces, when insiders, remember, managers announce that they're going to be repurchasing their shares for whatever reason, the market likes it. It's a signal which says that the insiders believe that their share price is below what it should be. Now, to be fair, most CEOs and financial directors I speak to always think that their share price is undervalued. And one sometimes needs to be a bit cautious about just going and buying companies that announce a share buyback, because sometimes the insiders have got share options which are about to vest, or they're hoping will vest soon, and they need the share price to go up for whatever other reason. But generally speaking, a buyback is a positive announcement for share prices. What about initial public offers? Well, we split these down into what we call the initial premium. This is what happens on the first day of trading. And we're going to see a bit of a fizz, a pop, and then we get the aftermarket excess return over the next few years. So this is some data. This comes from Jay Ritter, who is the guru in terms of IPOs. You can go to his website if you're interested, and you can update this data. He published this in the Journal of Finance in 1991. What he showed was that the initial, on average, the initial return based on what the listing price was 15% on the first day. And the raw returns they remained flat for about a year, and then they over 3 years they appreciated. But of course, so did the market. The markets, generally speaking, go up. And so if we adjust these things against matching firms, for example, so this would be comparing it to a similar company in its own industry over here, you can see that you get the 15%, and after about 18 months, you've lost the effect of that. It's pretty much where you would have been, and what's worse, it goes down after that. If you by small firms. They tend to lose their value even more quickly, and so on. So what we're really saying here is that, generally speaking, you get the advantage of an IPO just on the first day. And thereafter, it just fades away. After a year or so, it has pretty much lost its advantage. Now, it's interesting to ask then, well, why do we get this underpricing? So again, this is looking at J. Ritter's data. This was 10,626 IPOs over 33 years, and they were on average underpriced by about 15%. Why? Well, some comments. First of all, averaging is misleading because you've got some very big companies that list and some very small ones, and most of them are small. So if you did this on a market cap weighted basis, you would find this 15% is significantly lower than that. But the main reason why this happens is because investment bankers and others underwrite, typically underwrite IPOs. So that's because sometimes whilst the company is waiting to get its money and it's announced that it's raising capital, the market might crash. And so they get the shares underwritten. And the underwriters like to make sure that there's an incentive for investors to invest in this. And so they want this pop, this fizz on the first day. So it's there. Now, you might think then that if you went out there and invested in every single new IPO, well, on average, you get 15%. And actually you wouldn't. And we call that the winner's curse. What is going to happen to you is that if you subscribe, let's say, for 100 shares of this new, or $100 worth of shares for this new company that's about to list, and you just do that for every single new issue, what you find is that the market is watching these things, and the ones which are really looking good and are going to do well in the future, you're going to find that you are diluted and you don't get your $100 worth, you only get $5 worth because lots of people are subscribing. But for the bad ones, where in fact the markets analyze these things, but you just said, please give me my $100 worth, you get your full allotment, you get your full $100 worth because no one else wants that. We call that the winner's curse. So it's not so simple. So it's also true, again, if you look at research in different countries, you'll find that the returns on this is the first day returns, are generally speaking positive. The fizz and the pop is there, but it's different for different countries and at different times. And also you can do this analysis in what they call hot periods. There are times when markets are really buzzing, lots of IPOs are being done, usually because share prices are a little too high, and then bang, those things end, and then there are cold periods where nobody wants to issue shares. So we can also look at price reaction to other types of securities. Yeah, this is looking at the abnormal return over the first 2 days. We can see, even as we were showing, in general, abnormal returns over 2 days for shares are negative, but they're also negative for preference shares, convertible preference shares, convertible bonds, vanilla bonds. So there's, generally speaking, some sort of dissonance after investors have bought whatever it is they're looking for. What about secondary issues, what we would call a rights issue? Now, typically, these are priced a little bit below the current share price. That is because there's volatility in existing share prices, and it always takes time for this, for the invitation for people to subscribe to take place, and share prices may just, they do move. So we're a bit crazy just to not factor in some sort of discount. So typically, if the price is 100, they're going to issue the new shares at, say, 85. And if it's a rights issue, those shares are going to go to the existing shareholders, or they have the right to buy them. If they don't want to subscribe, they can sell their rights. We call that a nil pay letter. Those don't trade as well as they should. They're not that liquid, so they might lose part of the 15% that the shares are underpriced at, but they'll get something back. So, but one has to be careful about this, because sometimes we've seen, and here's a few examples I'm mentioning here, of companies that have actually issued new shares at a premium to their current price. Well, that seems crazy, because why would you buy the new shares? You can buy the existing ones for less. So generally speaking, what happens is the reason for that. The company, the insider knows stuff. They think their share price is too low, and the market goes and has a look and realizes, oops, yeah, maybe there's reasons for this. And so it quickly gets to where it ought to be. If we look at other market events, share splits have been in the spotlight lately, as Apple and Tesla have been announced that they are doing share splits. Now, a share split is really should add no economic value to a share. For every, let's say, if the share is trading at $1,000 and they do a 10-way split, you get 10 pieces of paper instead of one, and each one ought to trade at $10. So, sorry, $100 in that example. But what you do see in this little chart here is that there used to be lots of share splits being done per year. Right now, these things have become pretty rare, because people realize actually these things don't really add value. So why do companies even bother to do this? Well, the general argument is that retail investors, small investors, don't want to pay the very huge prices that it's going to cost them to buy Berkshire Hathaway shares or Tesla shares or Apple shares, which have, here's Alphabet sitting at its share price is $1,600, and Amazon, which is share prices at $3,400. And if you were to go and look at some other companies like Berkshire Hathaway, theirs might be well over $100, $100,000 in fact. So retail investors can buy fractions of shares, but it just kind of attracts more demand. So they do it. And what does the research show? Does a share split actually add value? Well, somewhat surprisingly, it shows that it does. Again, quite an old study, but if you look at updates, you can find that, generally speaking, it seems that certainly they do no harm, and generally speaking, they're positive. So let's talk about, just quickly here, how do insiders signal to investors? So the main source of information is the annual financial statements, and management issues these reports, and generally speaking, managers are optimistic and want to say good things about the company. They often have shares, so they're incentivized to be positive about stuff. The accounting rules in the form of GAAP and IFRS and so on, auditors try to restrict potential bias in what managers say, but investors kind of introduce their own distortions, and they can't really fully eliminate managers' optimistic bias. They just know that it's there, and they will also get to know managers, and they will get to know which ones are more optimistic than others. But it's a good idea to use your financial statements as a communication device to investors. One wants to articulate strategic direction and kind of tell them what you're aiming for and show them what you did. It makes sense to report as much as you can, but clearly you don't want to give away secrets or issues which are price sensitive and will later on disadvantage you in the market. So one has to be a bit cautious, but it's also good that you're consistent, that you don't ignore bad results. You need to talk about those too, and bad things, because otherwise investors learn that you never tell them the bad stuff, but only the good stuff. And what is key here is that you establish credibility. The company's been through a bad time. You need to tell them what you've changed and what you've done, and show them evidence of why things are going to be different in the future. So in summary then, perhaps the biggest thing that signals to investors are changes in dividend policy. And the main thing we know is that once you have started paying dividends based on some particular policy, stick to it. If you have to drop that and cut the dividend, you can anticipate a bad response in the market. The market wants to see the money. Secondly, buybacks are a signal that insiders view their share price as being too low. They think that it should be higher, and so generally the market responds, and when they see a buyback, they say, okay, It's supposed to be good. They know, insiders know more than we do. Let's buy the shares. But investors are wary. They do look to see and for information as to why you're doing this. Buybacks, of course, are not always what investors want, as we've been seeing prior to COVID. They didn't really want all this money that was coming back to them. They would have preferred managers to be investing in new assets and taking the business further. But companies were, I think, feeling that on the whole, the market couldn't absorb more. They didn't want to invest in more assets. And so they were saying to shareholders, listen, take the money back, see if you can do better than we can. When companies issue equity, generally is a positive signal as well. It's again saying we think our share price is too low and we're issuing new equity at a good time. Debt issues are also positive, generally speaking, because investors, particularly institutional investors, don't just give you debt. They first go and check out. They will do a due diligence on the company, make sure they've got collateral and so on. So it can be a signal that they think the company is doing okay. But again, one has to ask questions as to why they are raising debt. Is there a good reason? Is the company, if it's over leveraged, that could be a problem. So one's got to be careful with these things. Share splits should not really be a signal, but generally speaking, they do add something positive. So I hope you found that interesting.